Do you want to generate a steady income from the markets? This particular options trade can certainly pay you for your time, but it can also bite back quite hard if you are not careful. Many seek explosive gains, but there is a quieter, methodical approach aimed at collecting regular premiums. This method, the short-put synthetic straddle, is not for predicting big swings. It is for profiting when they do not happen. Built for moments of calm, when a stock meanders rather than sprints, it appeals to the patient trader who prefers small, consistent returns over time. So, what exactly is this rather complex-sounding strategy? Let us break it down into its core components to demystify it. The name short-put synthetic straddle simply describes how we build the position. A traditional straddle involves buying or selling both a call option and a put option at the same strike price. Call option. Put option. A synthetic position mimics the risk and reward of another position using a different combination of instruments. In this case, we create a short straddle profile not with a call and a put, but with stock and 2 puts. Short 100 shares and sell 2 put options, the 3 components. It is financial engineering to achieve a specific outcome. The construction involves 3 distinct actions executed simultaneously. First, you short the underlying stock. This strategy is not an all-weather friend, it is highly selective about its company and environment. The short-put synthetic straddle thrives in a very specific climate, a neutral market, low and stable implied volatility. Think of it as a fair-weather strategy. Do not deploy it during a market storm or when one is brewing. A neutral outlook means you do not expect a significant move upwards or downwards in the near future. You expect consolidation, price trading sideways within a predictable range. Implied volatility reflects the market's forecast for future price fluctuations. Low IV means smaller premiums, but it also signals stability, and you want that. You are betting the low volatility will persist. To make this abstract concept more concrete, let us walk through a hypothetical example using Procter & Gamble, ticker PG. We will use illustrative prices for clarity. PG is a good candidate because it is large, mature, a consumer staples company. Its stock often exhibits lower volatility than high-flying tech. It is the kind of company more likely to experience the calm periods this strategy requires. Assume today, 2025, conditions are right, and we implement the strategy. Imagine PG trading at exactly $150 per share. We believe it will stay close to that price for 1 month. First step, short 100 shares of PG at $150. That credits our account with $15,000 and an obligation to buy back later. Choose the 1-month $150 put. Suppose it trades for $1.50 per share. Sell 2 contracts. 2 contracts x 100 shares x $1.50 equals $300 credit. Your max options profit. Executing this trade requires precision and a clear understanding of the mechanics. It is not a single click. Multiple orders must be managed carefully. Confirm your thesis, neutral outlook and low implied volatility with no near-term catalysts. Only after confirming these conditions should you proceed. Check permissions to short stock and sell naked puts and ensure sufficient margin. Margin can be substantial and will fluctuate as price moves. Use a multi-leg combo order if available to synchronize fills at favorable prices. Leg 1. Sell to open 100 shares of PG. Leg 2. Sell to open 2 1-month $150 puts. Enter as a net credit order. Specify your minimum total premium. Monitor until filled. Execution is only the beginning. Record fills, expiry, margin held, and set alerts for exits. Max loss, cover price for short stock, and profit target. Entering is half the battle. Managing it to the end takes skill and discipline. This is not a set-and-forget strategy. Risks change quickly with price. Protect capital. Prevent small losses becoming catastrophic. Paths: price stable, hold close for profit. Price rises, cover short stock. Price falls, manage puts. Closing the entire position means buying back the 2 puts and buying to cover the 100 shares you shorted. Take risk off after, say, 50% of premium is captured, or at your stop loss. If the stock drifts down, your short puts rise in value against you. Consider rolling. Buy back current puts. Sell later dated, perhaps lower strike puts for a net credit. Rolling extends exposure. Do it only within a predefined plan. A sharp upward move is most dangerous due to the unlimited risk of short stock. Act decisively. Cover the short stock to cap losses, or buy a call hedge to define upside risk. One of the most critical concepts here is the asymmetrical nature of risk and reward. Your profit is strictly limited, capped at the net premium collected. Best case, the stock closes exactly at the strike at expiration. In our PG example, that was $300. Every penny away from the strike eats into profit. In stark contrast, potential loss is large, and on the upside, theoretically unlimited. The unlimited risk comes from the short stock leg. Stocks have no ceiling. A sudden takeover bid could gap PG from $150 to $200, producing a $5,000 loss on the stock, dwarfing a $300 premium. If the stock plummets, short puts go deep in the money and can force assignment on 200 shares. Even with gains on short stock during a drop, the net loss can still be significant. This imbalance demands small size and strict risk limits. Remember, you are picking up pennies in front of a steamroller. Beyond headline risk, costs and complexities can erode profits. Shorting stock incurs borrow fees, usually low for PG, but not zero. Commissions and fees on each leg add up on entry and exit. The bid-ask spread is a certain cost both ways, chipping at max profit. American-style puts can be exercised anytime. Early assignment can transform your position instantly. If one put is assigned, the short stock can be offset, leaving you with a different risk profile. Margin is dynamic. Brokers recalculate with price and volatility. Adverse moves can trigger margin calls, fail to meet them, and positions may be liquidated at the worst time. The financial and mental stress can be severe. Borrow fees, commissions, spreads, assignment, and margin. Include them in your calculus. These are often overlooked by novices, but essential for professionals. We have explored the mechanics, the ideal environment, and the risks. This strategy is an advanced tool for experienced traders, not for beginners. The promise of regular income can be a siren's call that leads the unprepared onto the rocks. Short stock and selling 2 puts create layered risks requiring active, unemotional management. Recap: income-focused, built for neutral markets with low implied volatility, constructed by shorting 100 shares and selling 2 at the money puts. You aim to profit from time decay and a lack of price movement. Reward is capped at the premium. Risk is substantial and on the upside, theoretically unlimited. Use small position sizes, disciplined risk management, and a clear exit plan from the start. Educate yourself thoroughly, then paper trade to practice in different market conditions. If you cannot monitor daily or act decisively, this is not for you. Seek guidance from a qualified advisor. Proceed with the utmost caution. So that's it. I wish you good luck with your trading. Thanks for watching and see you next time.